Hi, everybody. Thank you for participating in today's webinar session. I am Janice Parson, along with my co-presenter, Brian Sinclair, and we will be providing an update on regulatory developments as well as standard setting and technical accounting topics. So thank you for participating today. And a brief introduction. Again, I'm Janice Parson, a VP within RGP's Project Consulting Services team, and I lead a number of cross-functional initiatives within finance, accounting, and risk and compliance. And then I also focus on implementing or leading reporting implementation efforts that pertains to standards and frameworks. Now, just also a brief introduction or at least background with RGP. RGP is a global consulting company that serves over 2,400 clients, which includes 3/4 of the Fortune 500. RGP enables rapid business outcomes by bringing together the right people who together create transformative change. Now, Brian, would you like to provide an introduction?
Sure. Good afternoon, everyone. My name is Brian Sinclair. I'm the Vice President and currently the Technical Accounting Practice Leader within RGP. And I lead a great team, an outstanding team of technical accountants supporting all kinds of transactions from IPOs and SPACs through adoption of new accounting standards, through just addressing some complex transactions, whether that's restructurings, complex lease matters, and the such. I've been with RGP going on 7+ years, and my background is primarily in the Big Four, as well as in various financial leadership positions in industry. I'm looking forward to joining you, Janice, on this journey today.
Great. Thank you, Brian, for providing the introduction. Next, I just want to add a disclaimer and express that the views expressed in this presentation are really those of Brian and myself and does not necessarily reflect the view of others. And these slides are for educational purposes only, and they're not intended to be relied upon for accounting, tax, or other professional advice at this time. With that, what I want to just mention briefly in terms of today's agenda is that initially I'll be covering the regulatory and standard setting developments, and then start introducing a few key topics, and then Brian will also highlight a few other key topics and close out with PCAOB updates. Now, before we do that, we have a first polling question. And which organizational function do you currently represent? Is it finance, internal audit, legal, audit committee member or board, or other? And this can be either in terms of your organization or your client's organization that you're currently involved in. Give it a few 10-15 seconds here. Okay, great. So we have about over 80% from finance. So, well, welcome. And then a small percentage from internal audit and other, but significantly from finance. So great. That's helpful just for us background in terms of representation. Right. Now we'll just jump right in. Now, before I dive into the developments and the updates, I would like to initially provide some background and clarity around the different division and offices, because we will be referencing from time to time. And then, of course, ultimately, the SEC's role is to protect the investors and facilitate market formation. But also, in addition to that, is really having the oversight responsibilities with the standard setting bodies activities, which includes FASB. And because SEC has the power to enforce with public companies, but in turn, this responsibility also impacts the nonprofits and the private companies. And so because of that, we do tend to like to start with the SEC as a starting point, and then from there, discussing from other angles as well. Now, in terms of the divisions and offices, want to just provide a brief background on this. So the OCA provides consultation in the accounting, financial reporting, and audit matters that usually it's complex or unusual because there's not necessarily direct guidance that's been provided or issued. And so either public companies can reach out or ones that are planning to file can reach out to the OCA and provide and ask for consultation and advice on that. And then also OCA covers areas around auditor independence as well. Now, in terms of the DCF oversees the corporate disclosure compliance pertaining to securities laws and regulations. And so sometimes in terms of, you'll hear in terms of staff comments in response to filings, which typically is referred to as comment letters. This is where the DCF is responsible for that, gets involved in the reviewing and then having to provide the feedback and comments to the filers in a formal comment letter. And then now, if a company conducts something that's misleading or potentially misleading, this is where the division enforcement gets involved, where they can conduct investigation into possible violations of the federal security laws, and then prosecute the commission's civil suits in the federal courts. So, wanted to just highlight, this is just an example where the division of enforcement got involved. And a great example because it's significantly around the reporting and internal controls. And so for this case, mainly just want to highlight that for this Canty Leather, the retailer, they had an inventory tracking system that did not maintain the historical cost properly. And so as a result, the financial statements had inaccurate financial information and really led to the multiple issues that occurred and having the company being fined, as well as the CEO being fined and having to restate their financials. So just an example to share here. Now, diving into the SEC priorities and having to provide some highlights around this. So the OCA, at least to start off in 2022, the OCA had provided and communicated their commitments to high quality financial reporting, which includes having to focus on the accounting standard setting, the implementation, and the application of these standards and the audits. And then, as I mentioned earlier, but this also includes responsibility of the oversight of FASB and PCAOB activities, as well as engaging with IASB and engaging with stakeholders through the consultation. Now, transitioning over to in terms of from a rulemaking perspective, the last rule that was at least the most recent rule that that FASB had, that SEC had issued was the Holding Foreign Companies Accountable Act, which essentially is to prohibit trading if it's under this scenario. And this is applicable where if there's an issuer that uses an audit firm that the PCAOB is unable to inspect or investigate really for 3 consecutive years. And this is applicable where there's an audit report that's issued with a registered public accounting firm that's located in a foreign jurisdiction. So the intent really is to prohibit the trading on the market if that is the case. Now, the SEC has also proposed a number of rules this year. It's been very busy, but I just mainly want to highlight 3 rules here that's noted, which includes cybersecurity, climate risk, as well as the recovery of erroneously awarded compensation. So from a cybersecurity perspective, we'll talk about this a little bit, but initially want to highlight that's proposed to enhance and standardize the disclosures around cybersecurity risk management, strategy, governance, and incident reporting by public companies. Then in terms of climate-related disclosures, we'll also talk about this in a little bit, but it's really for registrant entities to include climate-related information in its registration statements and periodic reports. And the disclosure would include climate-related risk, the governance process around that, greenhouse emissions, as well as the metrics and targets. So it'd be interesting to talk about that a little bit more deeper. Now for the recovery of erroneously awarded compensation. This was initially proposed a while back, but it's been reopened again as SEC has interest to receive more feedback on this. But essentially, this is to establish listing standards that would require listed companies to be able to adopt and comply a compensation recovery policy, often known as the clawback policy, should a company have to essentially restate their financials. And so this is directed towards the incentive-based compensation, for example, stock options that a current or a former executive officer received. And this has been discussed for a couple of years, so I'm not going to go into too much into detail, but it is interesting that SEC reopened this. Now, what I also want to point out, just another important topic for the SEC, is that the independent audit oversight. So the SEC has increased a number of auditor independence consultations after the adoption of a rule. It's Rule 2-01 for the regulation SX in essentially October of 2020. But we're not going to go into too much detail in terms of topics pertaining to accounting firms, but just wanted to note that for awareness. Okay, so that was the SEC. Now I'm going to transition to FASB. And to provide background in terms of the FASB's priorities, I have to start with the agenda consultation report that the FASB has been working on for some time. So FASB engaged a number of stakeholders and published a formal invitation to comment last year and received over 500 responses. And interesting enough, a significant number of the responses were from the investor community, and then followed by the preparers and the practitioners. So as you can see here, the top priorities identified, interesting enough, digital assets came up number one in this, and then ESG related disclosures as number two. Now, FASB had used this feedback received to redefine its existing project agenda, as well as also identify new projects in the process. So I'm going to provide that introduction, dive into a little bit more detail in the next slide here. And so here I have the list of essentially FASB's list of priorities after the agenda consultation and their agenda consultation report that was issued fairly recently in June this year. But so there are a number of projects and a number of them that's keeping them busy. But I mainly want to just highlight the new projects and talk about that a little bit. And then we'll cover from a key topics perspective that might be applicable. So in terms of, from a new project perspective, there are three projects that FASB identified. One is pertaining to digital assets. The second one is software costs. And then the third is environmental credit programs. Now for accounting for and disclosure of digital assets, the objective really is to improve the accounting and the disclosure of certain digital assets. But noted that this does not include exchange-traded commodities. And I will highlight that a little bit later in this session. Now, accounting for and disclosure of software costs, just want to provide some background on this. The objective is to modernize the accounting of the software costs and enhance the transparency around the costs as well. It's pertaining to software costs that may be internally developed or it's for external use software. Now, so what does this mean? In terms of this effort, SASB has recognized that the current standard is outdated. More companies are working through software development through an agile environment, which is not necessarily as distinct and measurable, perhaps likely more so the traditional waterfall environment that was more likely, but nowadays focusing on working on this in agile environment just does not align as much. And so this means having to find a solution that possibly consider or merge two of the existing subtopics. For internal use software, subtopic 350-40, and the cost of software to be sold, leased, or marketed, subtopic 985-20. So SASB wants to look at these two subtopics a little bit more detail and possibly provide a merged solution. So stay tuned for that. That is on their agenda. In terms of accounting for environmental credit programs, this topic is officially on the technical agenda, and the objective is really for participants who are in the compliance and voluntary programs that results in the creation of environmental credits. And this also applies to non-governmental creators of environmental credits as well, and I will also highlight that in a little bit later. Now, the other thing I just want to highlight is the presentation and disclosure projects, and that these are also still important projects to stay close to, since these topics tend to trigger a significant number of recurring comments from the DCF, such as the disaggregation of income statement expenses and segment reporting. So just wanted to make sure to note that and stay close to that. All right. So then the next item I want to transition into is from an international perspective. Want to provide some background and priorities from the IASB and the IFRS Foundation. And interesting enough, the IASB also went through an agenda consultation, and they go through this every 5 years to forecast the next 5 years. And so this happens to be the time they went through this exercise in terms of late last year in preparation for this upcoming year. And this also helped them in terms of reprioritizing and looking at their current work plan and taking into consideration the feedback that's received. I do want to note and highlight, though, because of that, they have identified two new research projects, and one is around intangible assets. The other one is around the statement of cash flows. So from an intangible asset perspective, the plan that IASB is intending is to have a comprehensive review of the accounting standard on this, since it's been about 20 years old, and it was a completely different environment back then. So now to note that the board would like to evaluate from a broader spectrum, ranging from software to patents, IP, property, and IPs, and human capital, and not really just due to the topic of cryptocurrency, such as what FASB is doing, but they really want to just step back and look at it from a broader perspective. But they also want to keep in mind in terms of what FASB is doing. Now, in terms of the statement of cash flows, they would like to research and decide if there should be a comprehensive review or only identify suggested areas for improvement. And then in terms of climate risk, IASB already published some educational guidance back in 2020, but they would like to also monitor and stay close to this topic just so that they can be in alignment with ISSB. So that is on their maintenance agenda. Now, in terms of ISSB, this ISSB essentially was created back in November 2021, where the IFRS Foundation announced this creation, and addressed the creation to address sustainability-related disclosures to help investors make informed decisions about ESG matters. And even though it's newly formed, they have already issued 2 exposure drafts around this. One is the general sustainability related disclosures, which sets out overall requirements for entities to disclose sustainability related financial information, as well as the risk and opportunities associated with that. And then climate related disclosures, which is really built upon recommendations from the TCFD. And so TCFD is Task Force on Climate Related Financial Disclosures, and incorporates industry-based disclosure requirements derived from SASB standards. Now, the only point I just want to add here is that really, even though there are no decisions that are made yet, as ISSB issues standards in the future, it does not necessarily mean it's mandated. It really is up to the country or the jurisdiction to decide whether something is mandated and then refer to ISSB. So I just wanted to be able to add that. And here. So I know that was a lot of information across the SEC, SASB, ISSB, but now we're going to talk a little bit, dive a little bit more deeper in terms from a key topics perspective, and then point to the different applicability across the different bodies that were mentioned here. So before we do that though, we have the next polling question. Now the next polling question here, which topic has been a significant interest to you for this year? Is it ESG, digital assets, IPO SPAC, cybersecurity, lease accounting, or other? So I am curious to see what the audience selects here. We'll give it another 10 seconds or so. All right, great. So it seems like we have a significant interest here in ESG, so about 38%. Great. Digital assets, lease accounting, 22%, cybersecurity. All right. Well, this is great because these are all topics that we'll be covering today. So that's great to see there's interest around that. All right. So diving right in, the first thing, ESG. So the first topic I like to highlight really is ESG reporting, which stands for environmental, social, and governance. And now the topic of ESG is not new, and there are significant funds and investments around this. So if you can see here, 90% of the SP 500 already voluntarily report sustainability reports in some form or fashion. This is significant, quite a bit. The other aspect here is 120 billion in terms of net new money for Q1, Q2 of 2022 internationally focused on sustainability funds. So significant amount of funds. The third item just wanted to highlight, which is new, this is actually pretty recent, 370 billion in investment to target emission reduction and promote green energy. This is a new Inflation Reduction Act that just had recently passed Congress and was ready to be signed. So as you can see, there's significant interest to invest and to report. And there are proponents, and of course, there are also critics around the topic of ESG. And so I'll just talk about that a little bit. So from a proponent's perspective, companies say ESG's efforts may influence how they purchase and invest in that company. And then also companies want to have a way to share how they're acting responsibly with their employees, with their customers, suppliers. But then, as I mentioned, there are critics, and the critics may be talking about such as ESG ratings developed that ranks companies by how they're performing on ESG factors. which can create some frustration for companies. The other aspect could be the questioning of the fund or the investment product that may be labeled as ESG. So because of this wave of activities, regulatory and standard setting bodies are really paying attention. And so there's been a wave of activities from all fronts. Now, diving in, first I'm going to specifically focus from a financial statement related perspective and start with the SEC. So the SEC has already issued an amendment that requires businesses to include human capital disclosures that became effective in late 2020. But in terms of proposed rules, the SEC has two of them. One is applicable to the registrants directly, and then the other is more directly to the investment community. So many people have been talking about the first proposed rule, and I will also elaborate a little bit more in the next slide. So I'll first talk about the second one, which is ESG disclosures for investment advisors and investment companies. And the goal of the proposed rule is to determine whether a fund or an advisor's ESG marketing statements represent concrete and specific measures that are taken that address the ESG goals, as well as how the portfolio is allocated and determined. So the proposal will require investment companies and advisors to disclose the ESG strategy, present in a tabular format for easier comparison. And then specifically for environmentally focused funds to disclose the emissions associated with the portfolio investments. So that's an interesting proposed rule, and we'll be monitoring that definitely closely around that. Now, from a standard setting perspective, in terms of FASB's efforts, I mentioned this a little bit earlier, but I'll dive a little bit more detail. So in terms of accounting for environmental credit programs, this is on the FASB agenda to assess the requirements for participants in compliance and voluntary programs that lead to the creation of environmental credits. And these credits may include the ones created under the compliance programs, such as the cap and trade and baseline allowance programs, or essentially emissions trading with federal or regional programs. And this can also pertain to renewable energy credits, as well as renewable identification numbers and carbon offset credits. So this project is going to evaluate from a financial reporting requirement perspective, which it can also apply to the non-governmental creators of environmental credits. But the focus here is on the credits that are enforceable and tradable. So it's not pertaining to tax credits or investment related. Just wanted to provide that clarification on that project. And then just want to highlight that, from a topic perspective, this topic really initiated because of the diversity in practice without much direct guidance, such as transactions that should be accounted for in inventory or finite-lived intangible assets when it's purchased, but just in early deliberations. Now, the other research project is accounting for financial instruments with ESG-linked features. And since there's been a lot of challenges having to apply in terms of guidance from derivatives, for example, bonds with interest payments that might vary based on sustainability linked metrics. So stay tuned on this one to see if it gets moved into standard setting agenda. All right, so in terms of the SEC proposed rule on climate risk disclosure, wanted to highlight this a little bit more detail. As you are aware, as you may have been aware, March of this year, the SEC proposed rules to enhance and standardize climate-related disclosures, especially for the investor community, just so that there's more consistent, comparable information across the companies. And the proposed disclosures specifically for this would require public companies to submit within their filings details such as oversight and governance, material impact to the business and future outlook, process to identify, assess, and manage the risk around climate risk, and greenhouse gas emissions from more particularly Scope 1 and Scope 2, as well as the impact of possible climate-related events. And this includes disclosing financial impacts when they're summed cumulatively greater than 1% of a significant line item on the financials. And then other matters such as targets or goals publicly set, as well as scenario analysis conducted or transition plans. This also means the information would need to be tagged in XBRL. Now, for the larger organizations, such as the accelerated and large accelerated, this is the additional requirement to obtain reasonable assurance on Scope 1 and Scope 2 emissions. And that's why I wanted to, present in this table format. So you can see essentially the phased approach for implementation. Now, note this is proposed rule, so they have not communicated officially, but it has been defined in quite a bit of detail, and that is the intended plan at this time in the proposed rule. What I just want to note that from the elements that probably is maybe most sensitive for public companies and maybe causing stirs is really having to progress into the limited and reasonable assurance requirements for the large and accelerated, as well as having to estimate the financial impacts of possible climate-related events. But note that for small reporting companies and non-accelerated, they're not listed for the assurance requirements, although they are still subject to disclosure controls and procedures. The last thing I just want to reference is that we have also issued a blog on this. So if you have interest for more information, please check that out and read further on that. All right. So then the other item is really beyond the financial statements. And so beyond the financial statements, the ISSB issued the 2 exposure drafts, as I mentioned. But the other thing I want to just note and add is that there's a new EU rule that recently has been communicated out, or it's close to being finalizing. Essentially, it's requiring all large companies to publish regular reports on ESG. And I mainly want to just call this out because those of you with international operations, you may want to be aware of the applicability on this, because this is likely to be effective around 2024. So, and then the other aspect is that, so there are other non-financial statement related standards such as GRI and SASB and frameworks such as TCFD, but it's only for awareness. And then the other point here is that recently, this year, is that SASB is now part of the IFRS Foundation. So I just wanted to highlight that too. Okay. So the next topic I'm going to talk about is digital assets. But before we do that, wanted to at least provide a little bit background and definition on the type of digital assets here. And I really liked how NASDAQ had provided definitions on these assets. And I'm not going to be reading over some of these definitions, but I want to just at least highlight these and provide examples. And so from a cryptocurrency perspective, having to leverage the blockchain technology to be able to securely record the information and so that it cannot be altered. What you typically hear about is Bitcoin and Ethereum are the examples around the cryptocurrency. From an asset-backed token perspective, this is really more so in terms of having to provide and help on liquidity problems with specific assets. And the assets may be, for example, gold, oil, or real estate, and having to tokenize the assets to be able to help with liquidity. In terms of non-fungible tokens, you may have been hearing about this from time to time, but in terms of artwork and media recordings being sold through NFTs, so that tends to be in the form of that. Now, interesting enough, there's also the central bank digital currency, and it's the digital form of the country's fiat currency that's government issued. It's issued and regulated through a country's monetary authority or a central bank. And there are some foreign countries that have this, such as Bahamas and Jamaica, and China is currently piloting. Now, as digital asset transactions increase and fluctuate significantly, the risk and the volatility associated also with that have also increased and has triggered enough concerns that in March this year, the White House issued an executive order for multiple agencies to investigate and determine solutions to ensure responsible development of digital assets. And so this includes exploring CBDC for the US. So according to the White House, non-state issued digital assets reach a combined market cap of $3 trillion. So because with all the value involved and the volatility and things of that sort, the White House has stepped in to figure this out as well. Now, from the SEC's perspective, the SEC has shared that there's been increase in fraud and investment scams around cryptocurrency or crypto assets. However, in terms of SEC being proactively communicating on this topic, so far it's really been focused on the custodians of crypto assets and specifically those entities and exchanges to facilitate crypto asset trading, and then as well as case-by-case basis. So what I also wanted to highlight that is that in the past conferences in general, the SEC reconfirmed that registrants should be accounting for crypto assets, cryptocurrency under intangible assets. But then companies don't necessarily like that approach, especially since you have to assess for impairment at least annually, and then you can't really recognize the value increase until you sell it. So wanted to also just note that in April, the SEC staff issued SASB 121, again, focusing on firms that offer custodial services on crypto assets and the direction on how to record these custodial services on their financial statements. And specifically entities who safeguard crypto assets held on their platforms. The guidance recommends that the firms record safeguarding of liability as well as the corresponding asset at fair value. Now, in terms of other guidance, transitioning to that, the AICPA issued a practice aid that's in form of a Q&A, which I think is actually a little bit more helpful and insightful, especially for organizations who are just only handling and receiving crypto assets or digital assets. Now, at a highlight in general, according to ASC 350, entities should determine the useful life of the intangible asset, and if it's purchased with cash, initially measuring this at cost. But if this is a contract with a customer for a digital asset, according to ASC 606, the receipt would be treated in form of a non-cash consideration at fair value. Note there are also other scenarios to consider, so it really requires further evaluation depending on the situation that you're in. And then if the asset is to be remeasured for impairment, you just want to make sure you take into consideration the fair value measurement, so ASC 820. And then as I mentioned earlier on the FASB developments, digital asset was the #1 topic for feedback that FASB received. So as a result, I have accounting for and disclosure of digital assets to improve the accounting and the disclosure for a subset of exchange-traded digital assets. And now this will not include exchange-traded commodities. FASB will only continue to conduct research on that. But the last thing I want to just bring up, which to me is more of a curveball. So this month, a new bill was introduced into Congress, the Digital Commodities Consumer Protection Act, and it would give the CFTC, the Commodities Future Trading Commission, oversight to regulate trading of digital commodities. But what's key or interesting in terms of the bill that was introduced is that they referred to Bitcoin and Ether as commodities. So this would change what I've just mentioned here, although the bill is just an introduction, but we would want to monitor that closely as well. Okay, so that addresses digital assets. And actually, we want to just jump into IPOs and SPACs. Brian?
Great, thanks, Janice. So, understanding that there has been a slowdown in the IPO SPAC market over the last probably 9+ months, generally due to that decline in the equity markets, which does directly impact valuations, I think it's still worth reviewing some SPAC-related matters with everyone. And think about some of the first of all, the proposed rule by the SEC. Because of the significant volume of transactions involving SPACs over the last 2 years, in March of this past year, the SEC issued a proposal to enhance disclosures for business combination transactions between the SPAC and the target, what we typically call the de-SPAC transaction. Now, this proposal will address the treatment involving a shell company that reports under the 34 Act and also provides additional guidance on the use of their projections. The comment period for this proposal did end or was closed back on June 13th. Now, looking at to some of the Office of Chief Accountant or OCA consultations, by far the top issue identified from 2021 was the accounting for warrants. In fact, about 3/4 of all restatements of past financials were related to SPACs. The perspective was back in 2021, the SEC announced its view at the time that too often warrants that were being issued by SPACs were incorrectly being classified and accounted for as equity instruments. Now, SPACs generally will issue both private and public warrants, and their guidance based on US GAAP would require SPACs to reclassify these private warrants as liabilities and report them at fair value at each reporting period. But why? So US GAAP states that an equity-linked instrument must be considered indexed to an entity's own stock in order to qualify for equity classification. But the problem that the SEC noted was that too often these SPAC warrants contain provisions that provided for potential changes in the settlement amounts that were dependent upon the characteristics of the holder of the instrument. That is, these private placement warrants were generally not redeemable if the warrants are held by the SPAC sponsor or its permitted transferees. Oftentimes, you would see in the warrant agreements, these provisions were titled replacement of securities upon reorganization. And because the holder of an instrument is not an input into a pricing of a fixed option on equity, the SEC concluded that warrants should be classified as a liability. I refer you to ASC 815-40, which does provide the guidance to evaluate accounting for contract warrants by indexation and the equity classification criteria warrants that do not meet the index guidance. A reminder, fair value input is also relevant in the analysis, and as specified in the standard and in unique scenarios, entities should consider other variables for evaluation. Also, in terms of the DCF or the CorpFin, the Division of Corporate Finance, they emphasized very much the importance of disclosure on financial incentives of the SPAC sponsor to complete the transaction, including potential conflicts of interest and the risk to shareholders who continue to hold shares after the SPAC merges. Now, instruments to redeem or temporary equity is also an area of concern. Redeemable either early or after a merger, requires typically equity to be carried as temporary rather than as permanent equity. Now, redeemable equity features for cash that is outside the control of the company should also be classified as temporary, as it'll occur either when combined or when the entity is dissolved. But the SEC has noted in the past that companies have often classified this as permanent equity. And since companies would rather book as permanent to have a minimal impact to earnings per share, however, that's not the proper treatment. So we also refer you to ASC 480 for more guidance. Let's move on to cybersecurity. Another proposed rule was back in March of this year. The SEC proposed a rule and some amendments to enhance and standardize disclosure regarding cybersecurity risk management, strategy, governance, and incident reporting by public companies. To expand a bit more on this, the requirements included amending the Form 8K to report material cybersecurity incidents within 4 business days of confirming materiality and not based on discovery date. Other aspects of this proposal would require public companies to disclose its policy and procedures, management's role, and the board of director expertise on how entities identify and manage cybersecurity risks. Now, the element may take some effort for entities to define and agree to what classifies as a material cybersecurity incident to report. And their proposal does provide a few examples, but it will be up to entities to interpret those examples. The examples provided are an unauthorized incident that has compromised the confidentiality, integrity, or availability of an information asset, or violated policies and procedures. Another example was the unauthorized incident that may cause degradation, interruption, loss of control, damage to, or loss of operational technology systems. A third example that was provided was an incident in which an unauthorized party accesses or a party exceeded authorized access and altered or has stolen sensitive business information. A fourth example is then an incident in which a malicious actor has offered to sell or has threatened to publicly disclose sensitive company data or has demanded payment to restore company data that was stolen or altered. Let's move on to some FASB updates in 2022. Now, FASB has, we have a polling question to think about first. Polling question number 3. Are you currently aware of accounting standard updates that FASB has issued this year? Yes or no? I think I've already probably hinted. I'll give a few more seconds to respond. So fairly evenly split. So about 56% believe or understood that the accounting standard updates have been issued this year, and the other half were not aware. And it's unusual for, of course, in my perspective, for the FASB not to be issuing standards updates. Thankfully, in a sense, after I think I think we all sort of have a bit of a hangover from 606 and 842, but they continue to be fairly busy refining and revising, making some minor updates to a number of standards. For example, ASU 2022-01, which impacts topic 815 around derivatives and hedging. This applies to all entities that elect to apply the portfolio layer method of hedge accounting in accordance with topic 815. Now, I don't want to go into too much detail on these. I certainly I want you to go review the ASUs yourselves. But I certainly want to bring awareness to these. The second one is the ASU 2022-02, impacting financial instruments in topic 326. Now, this is a result of the post-implementation review activities since the issuance of topic 326 on outreach that was conducted. Now, the amendments essentially eliminate specific subtopic guidance on troubled debt restructurings by creditors, and provides direction to reevaluate the troubled loan as new or existing, as well as disclose current period gross write-offs by year of origination for the financial instruments. Now, this update is effective for fiscal years beginning after December 15th of this year, including any interim periods within those fiscal years. Thirdly, I want to mention ASU 2022-03, which impacts topic 820 around fair value measurements. Now, this update essentially clarifies that contractual sale restrictions on an equity security should not be considered in the fair value measurement, but to include additional disclosures around that. For public companies, this update is effective for fiscal years beginning after December 15th of this year, and for all interim periods within that fiscal year. And then for all other entities, this update would be effective for fiscal years beginning after December 15th, 2023. Now, I do want to have a quick reminder that FASB amended back in June 842 regarding the effective date for private companies and their adoption of 842. So this was amended effectively beginning December 15th for all fiscal periods after December 15th, 2021, or for your year-end companies effectively would need to adopt as of January 1st of this year. Now, there's been a lot of post-implementation feedback over the past several years and lessons learned with the public company efforts. And RGP, we have a lot of resources and experience available if you are currently in the planning and or assessment phase around 842. Let's talk briefly about some other top trends. And I do want to be conscious of everyone's time. I think we're about 8 minutes out from the top of the hour. So the Office of Corp Fin, in their most, let me step back. So back in December of 2021, at the AICPA conference on SEC and PCAOB developments, the SEC Corp Fin typically will come out and emphasize some areas that they're really observing in amongst the filers and try to really emphasize that with the audience. And one that always comes out is around non-GAAP disclosures. And of course, the prominence of non-GAAP disclosures. And the SEC refers to its compliance and disclosure interpretations, example, and guidance about these non-GAAP disclosures. Explaining when a registrant presents a non-GAAP measure, it must present the most directly comparable GAAP measure with equal or greater prominence. And the key point is that GAAP is still the foundation and should be the focus. Another area is around mislabeling of measures. An example of what was shared was the labeling of contribution margin, which is a non-GAAP measure used in place of gross margin. Another area that around non-GAAP disclosures was performance metrics. So if you are disclosing or including performance metrics, then those disclosures should include a clear definition of what that metric is and how it's calculated, a statement indicating the reasons why the metric provides useful information to investors, and thirdly, statement indicating how management uses that metric in managing or monitoring the performance of its business. Around corporate segment reporting. Now, this of course only applies to public companies, and CorpFin has communicated common themes that they see consistently that raises concerns. First, identification of operating segments, as the operating segment should be tied to the entity decision makers' use of the financial information to make decisions about operating matters. As you know, segment reporting really is a top-down approach. That is, how does the chief operating decision maker utilize financial information to allocate resources? And the challenge is often here is when companies are reporting a single segment when there are changes in business structures that is shared publicly that would suggest otherwise, that it's not truly a single reporting segment. Secondly, the aggregation of operating segments. Now, making sure that companies, the criteria and the quantitative thresholds that are defined under ASC 280 must be considered to determine whether to aggregate operating segments into reportable segments that are presented. And thirdly, around the measurement, entities should be consistent when reporting segment P&L measures if there are multiple segments included. Now, the concern here is that SEC is seeing that companies are often presenting multiple measures of the segments that are reported. CorpFin has also been providing feedback on reporting enhanced disclosures on entity-wide information. Let's go ahead and move on because I think we're running a little short on time. Let's cover a couple of PCAOB updates, and we do have one final polling question. What is an area affected by the pandemic, audit area affected by the pandemic and increasing PCAOB's inspection focus? 1, cybersecurity. 2, accounting for digital assets. 3, fraud risk and procedures. 4, none of the above. I'll give you a quick few seconds to respond. And majority of you responded cybersecurity. Second, fraud risk and procedures. And I believe, and Janice confirm, I believe the right answer is fraud risk and procedures. Is that correct?
That's right, yes.
That's what I thought. So let's move on to one more slide here. I think, again, we're about to run out of time. So in terms of PCAOB updates, so between 2021 and early 22, the SEC did appoint a new chair to the PCAOB and 3 board members, and they reappointed 1 member. Because of this, there is required some time for the full board to really settle in and reevaluate the agenda. And they have done that. So back in May, the PCAOB has communicated their updated agenda to share what is on the horizon. So some of their standard setting projects. 1, adoption of new requirements for the lead auditor's use of other auditors. That is, in many situations, especially in larger multinational companies, they'll have multiple auditors that ultimately will audit component pieces of the business that then report or issue their opinions and support to the primary, the lead audit, if you will. And so the PCAOB is adopting some new requirements, and the intent here is to strengthen those requirements for audits involving accounting firms and individual accountants that are outside of that accounting firm that issues the primary audit report. Now, this will be effective for audits conducted in fiscal years on or after December 15th of 2024. Other projects in 22 include around quality control, non-compliance with laws and regulations, and then interim standards. In terms of projects and research, data and technology research. Now this is technology-based tools and how they're affecting the nature, the timing, and extent of audit procedures to primarily address risks of material misstatement. And then also around staff guidance on audit evidence. And so they're evaluating the relevance and reliability of audit evidence that are obtained from external sources. And both of those projects are underway in May of 2021 and October 20, as well as October 21. And Janice, I think we're really kind of out of time here. So we will provide the full deck. And certainly if you have any questions or comments about any information that we provide, please reach out to Janice or I, and we'd be happy to discuss or provide those responses.
Yes, that's right, Brian. We are coming up to the hour, so we're just going to skip to the end here. And thank you so much for your time. We will be able to provide the presentation to you so that if you'd like to see the tail end of the PCAOB updates, as well as just what we have talked about, please feel free to reach out to us. And again, thank you for participating today.
Thanks, everyone.